be here. I'm glad to talk to you. This isn't quite exactly an American perspective on QE. This is more of an international perspective on American QE. So this is joint work with Saroj Bhattarai, the University of Texas. And we're going to talk a little bit about the conclusions of the empirical literature on U.S. unconventional monetary policy. Now, I had a slide here that cautioned you that I don't have time for a lot of questions because it's only 25 minutes. In fact, it's only 20 minutes. So we have plenty of time for questions. No. But I noticed that there haven't been many. Well, we're saving the questions for the end. All right. So what's on the agenda for today? First, sorry, shouldn't both do this, should we? Yeah. Okay. First, I'm going to talk to you a little bit about some models of unconventional monetary policy. Then we'll talk about the effects on financial markets and the effects on the macro, on what the literature has found on the effects on the macroeconomy, and I'll draw some conclusions. So, first, let's talk a little bit about the financial crisis. You all know, I'm going to give this super short shrift. You all know the source of the financial crisis. It was all about the housing market and housing bonds. It started in the summer of 2007. Their big event was that Lehman Brothers really seized up in September 2008. Initial claims and real activity, initial claims were soaring. Initial jobless claims, for those of you who don't speak macro announcement. Initial jobless claims were soaring, real activity was seizing up. The Fed funds rate was headed towards zero. It was at 2% up until September, and then it had dropped to the 0 to 25 basis point range by December. So what did the Fed do? Well, it engaged in unconventional monetary policy. That is, it engaged in forward guidance to talk to markets about where the federal funds rate and monetary policy in general was headed in the longer term future. And it also engaged in long-term bond purchases. That is, in Fed speak, large-scale asset purchases, or in the speak of ordinary markets, quantitative easing. So let's talk a little bit about the models of unconventional monetary policy. Oh, so take me down one more.
Yeah, me too.
Oh, back up.
Sorry, we'll do it one more.
It won't go to full screen? Why?
This is a browser.
Oh.
So we tried to open it with Acrobat, and the fonts aren't
That's what
embedded in the
Dowd
file.
used. You should never do what Kevin did.
Yeah. So, what should we expect? How should we expect unconventional monetary policy to affect the economy? Well, ordinarily we think about monetary policy working through asset prices, through yields, through stock prices, through foreign exchange and commodities. Interest rates are typically thought of first, and we'll talk a lot about those. Unconventional policy in particular didn't focus on short rates, which are the usual focus of conventional policy, but on long rates, because short rates were already at zero. So just briefly, long yield is the sum of an expected, tautologically or definitionally, is the subject of an expected future short rate and a term premium. And so we would like to know what happened to long rates, and we'd also like to know why things happen to long rates. So we'd like to look at the components of long rates. That is, we'd like to look at what happened to expected future short rates and to term premium. And we can measure the expected future short rate in a couple of different ways. One way is with a so-called swap rate. That is a risk neutral. It's a rate that's traded in market. It's a risk neutral expectation of the expected future short rate. The other is with term structure models, in which we can generate a model of the evolution of interest rates and measure the expected future short rate with those. Term premia have a variety of components in them depending on the type of bond. Generally speaking, all long bonds are going to have default or duration risk, which is the risk that is associated with level shifts in the yield curve. on their prices. Corporate bonds are going to be subject to default risk. Treasury bonds are going to have a liquidity premium that lowers their yield. MBS bonds have prepayment risk. All bonds are going to have local scarcity and a safety premium. So term premia differ by types of bond, and by examining the impact of QE announcements on different types of bonds, you can get an idea of what source of forces or what the channels are that actually change bond yield. So generally speaking, there are going to be sort of two types of effects on long yields of unconventional monetary policy. There are so-called signaling effects, that is, changes to the expected future short rate. And then there are, generically speaking, portfolio balance effects, and these are effects that lower the term premium. And in particular, we're usually talking about removal of duration risk as a significant impact. All right, how can unconventional policy matter in macro models? There's been a lot of talk about for instance, Chairman Bernanke's, former Chairman Bernanke's description of unconventional policy as working in practice but not in theory. All right? Just to clarify, although I can't read the chairman's mind, I strongly suspect, in fact I'm 99% certain, that the chairman could probably name you a half dozen models in which unconventional policy does work, and he knows perfectly well the theory as to why it would work. What he was saying is that sort of in the sort of simplified macro models that people often use, that there's sort of no room for unconventional policy, as I think that Jamie was talking about this just before lunch. That basically these models have simplified away a lot of the complexities of real financial markets that allow unconventional policy to have effects. Now, there are several different types of models that can provide unconventional policy effects. One type involves heterogeneity in preferences and assets and market segmentation. Another type talks about how unconventional policy can loosen binding leverage constraints on lenders. And finally, there's unconventional policy. There's a type of model in which unconventional policy can have effects because essentially it commits the central bank to a future path of policy. Now, what are the Fed's unconventional policies? I'm going to go through this pretty darn quickly. QE1, the Fed bought government sponsors enterprise, that is Fannie Mae and Freddie Mac debt, and Fannie Mae and Freddie Mac mortgage-backed securities. It also bought treasuries and more agency MBS. QE2 was all about treasuries. It was $600 billion in treasuries. The maturity extension program was a swap of short bonds for long bonds. So the Fed took long bonds out of the market and replaced them with short bonds. And finally, QE3 was made monetary policy state contingent and extended it indefinitely in 2012, but new purchases were gradually phased out in 2014. Okay. So the Fed's balance sheet, as you might have seen already, had started to grow exponentially, started to shoot up with some lender of last resort operations in September 2008, and climbed substantially thereafter. Effects on financial markets. How to assess the policy effects. The classic way that one can assess the effects of some sort of announcement, whether it's a conventional monetary policy announcement or macroeconomic news, is that you take some asset return and put it on the left-hand side of your regression. You have a measure of the surprise component of the policy announcement on the right-hand side, and you run your regression. You see how the surprise component of the policy announcement affected the asset return. The problem with this in the QE context is that what we would like to have as the surprise is the amount of assets purchased, or otherwise the way that some sort of a standardized way in which expectations might be changed, but those things can't be measured directly. And so an alternative event study allows you to essentially get the impact of an event, of a program, under the following assumptions. If you can assume that all of the changes in expectations about a program occurred on a finite set of dates, and you can also assume that the market got the total amount of the program correct, which is probably right, then you can basically take the sum of the asset reactions on those dates, and the sum of those asset reactions on those dates is going to equal the total impact of the program. Now, this is probably only true for QE1, and it's only true for QE1 because of the novelty of QE1 meant that markets were getting most of their information, or almost all of their information, about the Fed's unconventional policy reaction function from the Fed itself. So if you take a look at Fed announcements and Fed statements associated during the period of QE1 and sort of sum up the reactions to those policies, you can interpret that as the reaction to QE1. So QE1 was unique because it was novel and unexpected. There are also unhelpful event studies. There are a lot of ways to do things wrong. And if this was a 90-minute talk, I would tell you about all the ways in which you can do things wrong. Suffice it to say, it's bad. Okay. There are also sort of long-term regression studies with monthly data that try to determine the effect of, for instance, changes in the quantity of bonds outstanding or the value of bonds outstanding on yields. All right, so that's another way to assess policy effects on financial markets. Here's the bottom line of the empirical evidence. So, using studies from QE1, which are by far the most reliable, we estimate that $1 trillion of large-scale asset purchases lowered the 10-year Treasury yield by 30 to 50 basis points, the 10-year agency yield by 80 to 90 basis points, agency MBS by 66 basis points, the 10-year swap rate by 40 to 60 basis points, and the corporate BAA bond index by 40 basis points. It also lowered 4 and 10-year yields in other developed countries by between 13 and 25 basis points, lowered the foreign exchange value of the dollar by 3.5 to 6%, and it probably increased the U.S. price level overall by 2 percentage points, and increased U.S. GDP by a total of 10%.
Is that real or nominal GDP?
It's real GDP. All right. So here I've sort of go through the event studies that confirm all that stuff. I don't think you guys need to hear it again. You just heard all the results from the event studies. So I'm going to sort of I'm going to pass through this. I'm just going to note that there's support in these event studies for both the signaling and the portfolio balance effects, for substantial effects from both ways. Juan and I, we haven't done this before, so we're not quite like, we're like synchronized swimmers who didn't make the team, you know? All right, so QE1, Krishnamurthy and Vissing Jorgensen argue that QE1 was especially effective for pushing down MBS and mortgage rates. Now, here's a good question. Were the effects smaller in QE2? So I noticed, I'm not sure if it was Jamie or somebody else was talking about basically time variation or alternative estimates of the program's impact. My bottom line to you is that because we can really only tell the full impact of a program from QE1, after QE1, markets continually reassess their assessment of how much the Fed was likely to buy in the future, right? So expectations about future QE were changing all the time after QE1. Because of that, you can't really tell what the impact, econometrically speaking, you can't tell what the impact of QE2 or QE3 or the maturity of extension programs were. So there are papers that talk about time variation and the impact of the QE episodes. Respectfully, I think those papers are nonsense, okay? Because what they're doing is they're taking a bunch of announcements that were mostly surprises at the beginning and comparing them with announcements later that largely weren't surprises because markets already understood that QE was coming. 4 minutes? Okay. All right, so lots of evidence that QE increased mortgage refinancing and increased default premia. Lots of evidence that it had international effects both in developed countries and emerging markets. There are term structure models that talk about the effect on expected future short rates, and these term structure models again imply both signaling and portfolio balance effects. There's a literature, Jonathan Wright in particular wrote a paper that essentially argued that the impacts of QE were very ephemeral. That if you take a look at it, you do a structural VAR and you compute impulse response functions from the shocks, that they're very ephemeral, having half-lives of a few months. I do sort of an econometric rebuke to this and basically point out 6 different ways that his paper's wrong, okay? Jonathan is a terrific econometrician, okay? He's a great econometrician. Here he hit a clinker, all right? The paper, his model is structurally unstable, it doesn't forecast well, and it's inconsistent with rational asset pricing. There are all these debt regression studies that basically try to use monthly data to determine the effect of changes in the public's holdings of debt on yields. The bottom line on those papers is that they're really subject to a lot of econometric problems, and even though they basically support the inference from event studies, and they imply sort of similar effects as the QE1 event studies, I still don't trust them. I think they're subject to a lot of econometric problems. In particular, issues with time trends and persistence. All right. There are also low-frequency econometric studies. Thankfully, for instance, here's a nice paper by Hamilton and Wu in which they adapt the Vianos and Vila segmented markets model and calculate how much a given change in the debt holdings would change yields. And guess what? They get effects that are actually relatively similar to the effects from event studies. All right. Effects on the macroeconomy, again, much harder to estimate, okay? Because we can use event studies to isolate the effect of an announcement, but macro variables don't react like financial variables. They can't be measured at high frequency, and they're subject to all sorts of econometric problems. Now, so that makes it harder, but what have people come up with? Well, in calibrated DSGE models, you're either getting you're getting estimates that differ from each other, but you are getting positive estimates on GDP growth and inflation. And then there's a whole literature using vector autoregressions with monthly data that again, they're making different assumptions, they're measuring shocks in different ways, but ultimately they are finding fairly substantial effects on GDP and CPI. Now, I think that there's a lot more uncertainty associated with these studies than there is with the events, the financial market event studies, but still, I think that you're finding pretty much everything coming out in similar ways. All right, so my discussion in conclusion, we've got a theoretical literature that implies several different ways in which unconventional policies can have effects ways that I'm 102% certain that Chairman Bernanke understands and is familiar with. We've got an empirical literature that has event studies in which the novelty of QE1 set it apart and allows you to really estimate the impact of the program per se. Very difficult to estimate the impact of later programs, precisely because expectations are moving around all the time. You've got regression studies that basically are supportive of the event studies on financial markets, but on the other hand, they're subject to a lot of econometric problems, so frankly, I don't put a whole lot of faith in them. You've got calibrated models that are basically consistent with the event study estimates. So, sort of in summary, there's some strong evidence of announcement effects on asset prices of the QE programs. There are effects on international yields, on foreign exchange, on equity tail risk, obviously US corporate and housing bonds. There's fair evidence for modestly sized, that is a few percentage points, effects on output and prices.
You have 10%.
Yeah.
What's that?
You have 10%.
10% is a big number, but 10% over a period of some time.
How many? 5 years?
Couple, 2, 3, 4 years.
And that's virtually all the growth.
Yeah, well, I think that what's that saying is that without QE, the dip after 2008, 2009 would have been a lot worse. And, as it was, we had fairly modest, somewhat sluggish growth. And without QE, we would have had none, and in fact, negative growth, perhaps. So QE has spawned advances in thinking about financial frictions and about the shadow rate literature. Oh, and by the way, I should say, when I say 10%, I'm saying this is what the literature is saying. I'm not saying this is my result. So I may be skeptical of the 10% too. Maybe I think it's too high, maybe I think it's too low. This is what the literature is saying. Okay. So I am finally done. So it's 22 minutes instead of 25 or 20, so I split the difference.